From St. Louis, and with me, my host, the president of the St. Louis Fed, Jim Bullard, and Chris Varvares joins us, of course, with the National Association for Business Economics. Chris was telling me a story. You became head of the Fed as an academic, and you walked in on the data guys and said, "What's data?" or something along that line.
That's completely false.
That's completely false. It is about market forecasting. It is about trying to get the numbers early, right?
It is about data, but it's not just about data. It's data and theory, and it's that all makes a big circle, and we have to get it all to be consistent.
You have been pushing against the doom and gloom for months. You track GDP. What is your tracking saying right now? And I would suggest reading your literature. It's a pretty good economy, isn't it?
It's not a really pretty good economy. I think the economy is still soft. The numbers look better than what I think the perception is. 2.7% growth of GDP in the third quarter, 2.5% in the fourth quarter. You know, not bad.
Now let's bring up a note of the day here from Macroeconomic Advisers. Chris Varvares, Joel Prakin, and Lawrence Meyer, of course. For the third quarter, IP increased at a is that number true? I think that may be a typo. 5.1, is that really true?
Right.
Wow, our latest tracking estimate of 2.7% GDP. These are not 9% unemployment numbers, are they?
Well, you know, there's a level versus growth effect. We're still climbing out of a very deep hole. Unemployment rate is stuck up around 9%, and we don't think it's going to get much below 9% for another year. And in part because we're only going to be growing at about 2.5% is what we think over the next 4 quarters.
I would suggest it's different than the forecast.
Still, I think there's important news here because in August you were looking at people really marking up their recession probabilities a lot.
Yes.
And those are now being marked back down. Even though the financial stress is still high, I think there's more faith that the Europeans will come to some kind of solution. It won't be fast. It'll go long and bumpy, and they will not solve it in a week here. But I think they're moving recession probabilities down, and that means 2.5% to 3% starts to look very good.
Are Fed forecasts behind macroeconomic advisors? Are you by definition late in your analysis?
Oh, not at all. We're analyzing every day and forecasting every day. So
they're just not reporting it every day.
They're just keeping it secret. Yeah, I see that with the security to get in here. Let's do chart 6 if we can. This is the income story. We've heard about the wealth distribution, the income distribution, and we regressed here back a zillion years, our national anxiety, real personal disposable income. And Chris, it's just rolled over. Is that structural, or do we just assume if we get a better economy, it finally comes back?
Mostly it's cyclical. I think there's another factor on top of it, which is there's a bit of a disconnect between how the U.S. is doing and the rest of the world. So energy and commodity prices have been up, even though the U.S. economy has been soft. We haven't had much growth of wage and salary income. Mm-hmm. On top of that, we've eroded that nominal growth of income with fairly significant increases in food and energy and commodity prices. And so real income growth has been slow. I mean, not terrible, but slow.
Final question, and this I know President Bullard's been focused on, investment. Do you see a sustained business investment, and can residential pick it up?
Yeah, we do see sustained business investment. The good part of it looks like the structures component, which was very, very weak and which lags the cycle, appears to have finally turned up convincingly. We expect that to continue, maybe not at the same pace surely as in the second quarter when it rose at over a 20% annual rate, but we see continued growth there. And on equipment and software, still coming along quite well, picking up, not quite as strong as it was last year when it grew at a 10% rate, but something in the maybe 7% range.
We're going to have to leave there. Chris Varvares.